Advice for Clearaway, presented by Jacob Wotton. This presentation will discuss the forecasting of Clearaway regarding the business's financial position and the desired $60,000 vehicle purchase. The presentation will also include an analysis of the business's financial statements with an interpretation for Simon Birch to understand the figures and equations. Recommendations will also be offered for Simon Birch to improve the position of Clearaway and push the business in a positive direction. These include your receipts from debtors, which illustrates the inflow of cash from customers which Clearaway has sold services or stock to on credit. This figure totals $328,500. This being Clearaway's only form of operating activity inflow could be concerning if it does not support the outflows and expenses of Clearaway. The receipts to creditors are the payments from the business to any account which the business has made a transaction with using credit. Example of these could be suppliers, where Clearaway may have purchased stock using credit. Clearaway has accumulated an outflow of $107,600 to all creditors. In 2019, Clearaway prepaid $12,000 worth of electricity, which carried over to the 2020 electricity expense of $32,000. Meaning Clearaway only needed to pay $20,000 in 2020. Clearaway does not have this advantage in 2021 as there was no advanced payment on any account. The last operating activities outflow to be discussed is Clearaway's wages expense. At the start of 2020, the business has $6,000 worth of unpaid wages. In 2020, Clearaway was able to successfully pay the full year's expense of wages at $85,000 and was able to chip away at the accrued wages expense, paying $1,000, reducing the total accrued wages account to $5,000. Clearaway's cost of goods sold was calculated to complete the following financial ratio. The inventory turnover is a calculation which finds the amount of times a business's stock has experienced a total turnover, where stock is completely replaced from the previous turnover. In the period of 365 days, Clearaway's turned over stock 4.5 times, on average every 81 days. This ratio is close to the ideal rate within the market, as the ideal ratio is stated to be between 5 and 10 turnovers a year. As stated in the provided information, Clearaway is supposed to have a 14-day payment policy, which is not being upheld by the customers. Customers on average are paying every 38 days, and it is clear that Clearaway does not have any repercussions for late repayments, which will be discussed in the advice. The following calculations relate to Clearaway's profit and management of accounts. Clearaway has an extremely poor return on their assets at 0.79%. Less than 1% of their total assets being committed to the business is being returned in profit. This figure should preferably be over 100%, as that is the break-even point. A positive within these few equations is the working capital ratio, as in 2019, for every $1 worth of liabilities, the business owned $3.23 worth of assets, and in 2020, this total grew by 4 cents. Between the gross profit and profit margin, there is an extreme difference. Responsible for this discrepancy is the business's expenses. These two calculations calculate how much Clearaway's revenue translate to profit. The gross profit is before the expenses are taken away. However, once Clearaway's expenses are taken, they experience a loss of 6.09%, which needs to dramatically improve if Clearaway wants to continue operating. Dear Simon Birch, after reviewing the financial statements of Clearaway through a 2-year period of July 1st, 2018 to June 30th, 2020, the current financial state of Clearaway is under scrutiny. Presented in a comparative balance sheet, income statement, and a personally created cash flow statement, it is evident that Clearaway is in an alarming position as Clearaway's cash assets are depleting and Clearaway is not gaining revenue, as in 2020, Clearaway experienced a loss of $20,000. The following report will discuss the profitability, liquidity, and stability of Clearaway and will offer advice regarding Clearaway and the appropriateness of purchasing a new vehicle for $60,000. The profitability of Clearaway is certainly a concern, considering that in 2020, the business had a loss of $20,000. With no knowledge of the revenue sales in 2019, a gross profit or profit margin cannot be compared. However, a comparison can be made between 2019's and 2020's profit. The profit from 2019 to 2020 plummeted with a decrease of 500%, from a gain of $5,000 in 2020 to the loss of $20,000. This follows a trend within 2020, as the profit margin of negative 6.09% and the return on owner's equity equals negative 6.66%. Understanding that these figures appear small as a percentage, but their impact is much larger when considering the values of the assets at stake. For example, the negative 6.66% means that your average contribution of $300,000 loses you a total of $19,980. The business is unfortunately not reaching goals in many sectors, notably the 14-day payment policy implemented by Clearaway. Currently, debtors' turnover rate is at 9.5 times, equaling a turnover of payments every 38.25 days, 170% slower than the target. Their ability to turn sales into cash is increasingly worrying, as Clearaway was able to make $390,000 worth of sales all on credit, but ended the year with $5,400 in cash, $10,100 less than the year prior. $68,000 worth of sales and services is still owed to the business from debtors, and $6,000 worth of bad debts are totally lost. Reviewing the business's inability to translate sales into cash revenue will push away any potential stakeholders of the business from either investors or partners. The only possible way is if Clearaway in the next 2 periods experiences a positive growing trend, indicating to stakeholders that Clearaway has potential and is worth working with. An external stakeholder which will be affected by the business's financial position is suppliers. Clearaway has a just under ideal inventory turnover rate of 4.5 times a period. However, owes creditors a total of $25,400, increasing from the $10,400 from 2019. Having made $123,000 worth of purchases, the business's inability to create profit can affect relationships with current suppliers, and when new potential suppliers view Clearaway's financial support, there is a high chance for a refusal to sell anything to Clearaway on credit. The stability of Clearaway is eerie, and Clearaway is in no position to make the desired $60,000 purchase for a new vehicle. As the business has a loss profit during 2020 and has only $5,400 worth of cash available, there is no possibility of purchasing the vehicle using Clearaway's funds. The only possible way for you to purchase the vehicle is using a bank loan, which is both unadvised and unlikely. The bank is another external stakeholder which Clearaway owes $230,000 to. Increasing the figure to potentially $290,000 is a damaging idea, as in 2020, Clearaway paid $24,000 in interest. Supposing the loan's interest rate is 10.43%, adding more amounts to the incredibly high fee will accumulate Clearaway's large amounts of interest. However, the possibility of this loan being accepted is very unlikely, as the bank will view the 2020 reports and see Clearaway has no profit and is most likely to decline the loan. There are many issues with Clearaway at the moment, and action needs to be taken immediately. After reviewing the key issues, a few short-term and one long-term solution to support Clearaway in 2020 were formed. The first was to charge debtors interest on late repayments. Looking through the accounts, it appears to be that there is no interest receive account. Introducing interest on customers' credit purchases can potentially increase the debtors' turnover rate and provide another avenue to receive revenue. Creating new avenues to receive revenue is a large area which needs to improve. Reviewing the current market and competitors can lead to finding new ways to receiving revenue. As important as increasing revenue is, reducing Clearaway's expenses in 2021 is as crucial as anything. Either finding cheaper services in areas such as electricity or waste dumping. Another way to reduce expenses is to reduce wages by letting staff go. This should be the last option and only if necessary. A long-term action is to set up an interest-only account to repay back the bank's loans. These are effective in repaying loans and can save Clearaway thousands worth of interest in the long run. Clearaway is in a concerning position financially, and a lot of maintenance needs to be done to turn their business around. Many businesses suffered from the COVID-19 in 2020, and hopefully 2021 is the year to turn Clearaway around. There is no clear date to when you are able to purchase a new vehicle. However, this should not be a priority, as forming revenue streams and paying back loans is the business's number one necessity.